Hi, everyone. Welcome to this week's episode of FI Talk. This week, we're going to do a deep dive into something we're passionate about, and that is getting your first rental property. So, both Tom and I do have rental properties, so it's something we have experience with. And we are also both mortgage agents, so we have a lot of experience setting these up for other people. So, Tom, why don't you kick things off? Tell us a little bit about what you have in your portfolio currently and kind of your plan for where you want to take things.
Yeah, for sure. And you touched on it a bit there. I think it's cool because we get to see behind the scenes of what's working best for our clients, and a lot of that we're going to trickle into the podcast. So we're excited about this one. And from like a personal perspective for my portfolio, I'm at currently at 4 properties. One is owner occupied. 3 are my other rentals. I do have one that I might be pulling trigger on soon. So the first one, first rental property is actually, I did have another one that didn't go through, but the ones that I have now, I have a condo in St. Catharines, Ontario. I have a townhouse in Lincoln. I have a property in Indianapolis in the States, which is, I know it's random. And then I have one townhouse in Calgary. And I don't know if you want to like go into each one and kind of how I stumbled upon that, but we can definitely touch on that and go from there if you want.
Yeah, why don't you give us like a high level overview of each one? Kind of how did it come across your desk? How did you analyze the deal and what drew you towards those properties?
Cool. So the first one, let's start with Calgary. So Calgary was actually a really easy one, and I actually have a YouTube video going over the whole deal breakdown and how I stumbled upon it. But the gist of it was I wanted something that was more hands off, and this is kind of goes into my last episode that we just pushed out regarding how I pivoted from my old style of investing in real estate to now I wanted to be more hands off. And I'm even going deeper on that. But at this time, I was like, you know what? I want to buy a rental property. I want it to be under my own name, but I also don't want to have something where I have to do renovations. I have to do, say, like a BRRRR method. I just wanted something where I can buy, hold it, it's turnkey, and then I could just sit on it and let it appreciate over time, have that tenant pay down the mortgage over the 15, 20 years, however long it is. So this one was super easy because it was a new build construction in Calgary, and it closed within a year of buying it. The down payment and deposit structure was super simple. It was 5% over a period of time, which is pretty standard for a lot of new builds. Anyways, rental property, now we have that tenant in there ready to go, has been there for the past year, and I haven't had any issues with it. It's probably been the easiest property that I have.
Nice. And if I remember correctly, going back, you bought that property and kind of the deal structure with the company was that they were guaranteeing the lease, were they not?
Exactly. So we started out, that was the cool thing about this one. Like I was a little skeptical, to be honest. I was like, I don't know, it seems too good to be true. It comes with property management, it comes with the tenant, like they put the tenant in there. It cash flows from day one. So I was a little skeptical, but then I did more research in the company. And then I also looked into the area in Calgary as well and realized like Alberta, the cash flow is just much better than here in Ontario, which is one of the reasons why I went there, and the landlord law, which we can that's a whole other
That's a whole other
topic.
can of worms.
Yeah,
Yeah,
exactly.
that's an episode with drinks, I think.
Yeah,
Um,
100%.
nice.
Yeah.
And Alberta actually is booming right now. So a lot of Ontario has seen some prices come down and whatnot, but Alberta is one of those markets that's really picked up quite a bit of steam. So I think your timing there was probably perfect.
Yeah, and it's funny because we're seeing that on our side too, eh? Like, I don't know about you, but I've had a lot of clients lately that, are even just kinda thinking of picking up and moving to Alberta just because of the prices here.
Yeah, I've done a couple deals in Alberta as well, and it's a little bit different. We were able to do it for a bit. Now we kind of have to pass the baton to someone else just for licensing perspective, but we can help out if you are making the move to the Great West.
Yeah, exactly. But yeah, it's like to further elaborate on that, we had that company, the property management company, in place for a bit. We actually ended up getting new renters in and increased the rent because naturally over the year that we had it, the rent increased, which was nice for us. And the tenant also needed to leave, and we had a new tenant come in and sign. So we switched property managers to increase the rent for us too, because the original deal was for the property manager company that we started with, they guaranteed rent for 2 years. It may have been 3 years, but 2 or 3 years, they guaranteed the rent regardless if the tenant was in there or not, which was pretty cool. But they would shave off, I think it was about $200 from what we can actually get on the market for rent, $200 a month. So what we did is we just pivoted and we went with an actual regular property manager, and we kind of disbanded from that, and we increased the rents to increase the cash flow.
That's cool. I like it's kind of like a built-in insurance policy while things get started and while you get to know the lay of the land. So that's awesome.
Yeah, exactly.
Okay, and you have a condo, which is kind of interesting because a lot of investors keep condos out of their portfolio for the condo
Yeah.
fees and cash flow and whatnot. So how did you get the St. Catharines condo in there?
So I bought at the right time. Like I'm not saying condos are a good or bad thing. I just think it's really it depends on the type of investing you want to do. Like if you're someone that is investing for the cash flow perspective and you're trying to replace your 9 to 5, then stay out of condos because that's not where you're going to get it. And when I bought at the time, it was a lot more favorable than it is now. Like if I were to buy another property, it wouldn't be a condo, especially in Ontario. Like you're going to be in such negative cash flow. But at the time, it made sense, and I'm happy that I did purchase the condo. But yeah, like I said, I want to be mostly hands off with my investments, and that's the route I wanted to go because it is less maintenance from a month to month maintenance perspective versus going with a fully detached home. And that was one of the main reasons why I went with a condo. And
Mhm.
yeah, like I said, timing wise, it just made sense.
Nice. And then you do have the detached home in Indianapolis. Is that how you say it? I don't even know the
Yeah,
exact.
yeah.
Yeah.
I always just say Indy.
Indy.
It's a
Yeah,
different.
Indy. Yeah.
Yeah, so that one was I touched on this briefly on the last episode. I went down like a huge rabbit hole where I wanted to really just build out a bunch of like a huge portfolio in the States, get, 30 to 60 properties under my belt, like all fully detached homes where they all cash flowed about, I think it was like around $350 a month cash flow for purchase price of around 100 to 125K at the time.
Okay,
It's
that's
probably
solid.
changed since then. Yeah, man, like that's my property there now. Is we bought it for I want to say it was like 114, 124, something like that. All US, obviously. And it cash flowed from day one, even after just doing some like tenant turnover renos. Like we didn't have to do a full complete gut job reno. It was like literally 15K of renos. And we cash flowed 350 a month and got that nice 30-year fixed mortgage.
Yeah, and
Which
in the
was nice.
States, for those people who haven't listened to the US episode, you can keep your rate for 30 years. So when Tom got that property, he locked in a rate that was pretty attractive, and he can hold that until he decides to either sell the property or if rates come down considerably, he could refinance, break it, and get out that way.
Yeah, exactly. And it's it's not all sunshine and rainbows. Like that's the property that we've had a bit more of a headache with. It hasn't been horrible, but we've had some tenants that we had to turn over that weren't the greatest. And yeah, property manager issues as well. Like we didn't really the first two property managers were garbage. So it comes with headaches, and that's kind of where I pivoted to go in the Calgary and the condo route.
Nice, nice. And your last
Yeah.
one is your owner occupied, correct?
Yes,
Yeah.
exactly. Yeah.
So that's
Yeah.
we won't touch on that one too much because
Yeah, you sure you don't wanna go over
yeah,
that?
we won't share where you live and
I'll
all
tell
those
you that the
details.
cash flow is not very favorable.
The owner occupied rarely is,
Yeah,
unless you can get someone in the
unless
basement there. Yeah,
exactly, which we're gonna touch on.
yeah, we'll touch on that in a bit. Yeah, so I've just got
So
one right now, and it's in Sarnia, Ontario, which is a place I was drawn to because I had investors from the GTA start looking at properties there, and I realized the property values were quite low, the rents were pretty high, and so I just eventually had a client come to me and they were selling their owner occupied home, buying another, and they needed to get an offer on their place quite quickly. And I was like, you know what? I'll just buy it from you. And that became my first rental property. So it's nice. My
and
tenants are great. They take good care of the property. Uh, they pay early every month, which is a
that's
rarity.
amazing.
And yeah, so it's nice.
I was just gonna ask you that because we haven't really had a chance to to sit down and talk about that one too much. So overall, quick, easy close. Your tenants
Yeah.
are great. Does it cash flow?
Cash flow is about 350 a month, and that's at
Oh,
a pretty
beautiful.
high rate. Like, I closed on it in May of 2023, so rates were not good.
Yeah.
So year after year, it's only going to get better.
Nice. That's awesome,
Yeah.
man. And do you see yourself expanding the portfolio for the real estate investing, or are you going to pivot more towards your other investing that you've been doing?
Yeah, so like I'm kind of on the fence. So I might get something more in the GTA and do a bit of house hacking, like we are going to talk about in a few minutes. That's something I'm curious about doing here. But I also really like investing in the stock market, and that's where I've
Yeah.
actually had greater success and greater gains. So I will probably continue that strategy and then maybe grab one more property for the time being. That being said, we are in the real estate space, so we see a lot of things and opportunities pop up. So I'm not going to lock myself in any sort of statement that typecast me. I'm sure something will come along where I'm happy to pick it up.
Yeah, you're not gonna shut it out completely. I mean, maybe you concentrate more so on one thing versus the other, and I think you and I have switched mindset on that a couple times in terms of, like, whether we should focus more into real estate investing or whether it's the other style of investing, like, I guess you can call it lazy investing, where you've got your stocks and ETFs and building out that portfolio, and I think the next 2 years should be interesting to see, like, where you and I are at in terms of, like, where we wanna pivot to.
For sure. And it's also the kind of thing too, when you get cash flow, both of us are incorporated. So you get cash flow into the corporation, you can then send it to a holding company and buy those investment properties. And it's a nice way to get assets that way for us, where there's not kind of a retirement piece built into the mortgage and real estate space. So these properties kind of become that retirement portfolio. And then the funds you draw from your corporation, you pay yourself. That's what you're putting into your TFSA, your RSP, et cetera, and growing that egg as well.
Yeah, and there's so many other tax benefits when it comes to being incorporated. And it doesn't have to be your own you don't have to be a business owner per se to be incorporated. Like you can open up a hold co just for your rental properties, and we won't do too much of a deep dive on that because we're not accountants, but just know you do have options, and definitely recommend or definitely reach out to an accountant before you start something in your real estate journey, because you might make a mistake early on in I see people even open up holdcos too early. Sometimes it's too early to do it, and it doesn't make sense.
Yeah, there's definitely strategies and stuff like that where it's worth paying your accountant a couple $100, just sit there and just map it all out. And I know we've done this with our accountant this year just for the business and where things were going. And it gives so much clarity to know, okay, here's the next 5 things we have to do. And like, don't do X. And it was like, oh crap, we totally would have done that. And so it saves some future pain, even though you do have to pay quite a high hourly upfront for a good one, but it's definitely worth its weight in gold.
Yeah, would you rather pay the hourly or would you rather pay the land transfer tax transferring the title over to either one, right? You're going to pay thousands with that option versus paying a couple hundred, couple K maybe to your accountant for the tax advice.
For sure. So
Yeah.
why don't we do a deep dive kind of on if you were to start today? So you have no properties. We'll say you don't even have an owner occupied. You're waiting for the time to jump into the market. How would you get a property and how would you do it?
Man, so if I were to start over, I would house hack. So house hacking is essentially you're renting out a portion of your house. So what I would do is I would buy a duplex, where a duplex is you have two separate units in the home, live in one of them, rent out the other. So you have someone paying down your mortgage. Your mortgage payment itself is going to be easier because you have someone helping you with the payment. You're building up that equity because you own the home, you're in there, and it's because your down payment, you're going to be required to pay less of a down payment versus if you're buying a straight up rental property, you're looking at a 20% down payment minimum.
Yeah, for sure. So just to add some more layers to that, if it's owner occupied or part of it is, you can put as little as 5% down. And then if there's a basement unit or if it's a side by side duplex, triplex, etc., you can use 100% of that rental income and add that to your income for qualifying. So it allows you to qualify for more of a mortgage, and it also helps in paying down that mortgage. So I did quite a few of them last year for clients, and it was amazing looking at what they collected from the rent versus their mortgage payment. And they had a mortgage payment that was less than their area's rent. And they were just laughing because they're like, this is so cool. And I'm like, the best part is you got this for 5%. Stay here as long as you're happy. But like, down the line, you get married, you have kids, you need more space. You now have 2 units to rent out, and you can go put 5% down in the next property, and you're just building that wealth snowball.
That's the key, man. If you have another, so if you want to make that transition, like you could easily just hop to, not easily, but you can hop to the next property and put that 5% down if it's going to be another owner occupied. Or if you want to go crazy, you can buy that other duplex and do the same thing, rinse and repeat. And you're not having to put that 20% down. And it's like, hey, I'm moving to this next property. I'm going to put the minimum down payment. I have another unit in it, so I'm going to rent that out. My old property, I'm going to now get a new tenant in the second unit, and then now that's fully rented out, and that's just a straight up rental property. And I imagine at that point, you're probably cash flowing pretty good because you've been sitting on that property for a bit now.
100%. And the other piece to this too is like strategically, a lender wouldn't like it if you came to them and you say you had a 1,500 square foot house, detached single family home there, and you're like, now I want to go move into a duplex that's like
Yeah.
700 square feet each unit. It kind of raises the alarm bells with them. It's like, why do you want to do that? It seems like you're just trying to game this and buy a rental property with 5% down. Whereas if you start with the duplex first, it's totally different, because it's like, that makes perfect sense. House
Yeah.
hacking is a great way to make sure you can make your payments, and strategically it's so much stronger for them.
Exactly, and that I'm a perfect case example for that, because if I were to move out of my home now into a duplex with a newborn child, they'd be like, okay, what's going on here? You're downgrading from your square footage now to like half of what you're living in now. Like, it doesn't make sense. So
Yeah.
that's where the red flags go off, because people try to. I mean, it's mortgage fraud. If you're trying to just buy this one property and claim it as an owner occupied, but it's a straight up rental, like that is mortgage fraud, and lenders try to look out for that. So, yeah, you're not going to get it with that.
Yeah, and especially for guys like us who know the game and know the system, a lender's gonna look at that and be like, "Tom, no fucking way are you doing
Yeah,
are you doing that? Like, you have your best year yet, and you wanna downsize your home by 50% with a newborn." Like, it doesn't make any sense, right? So,
yeah, exactly.
you're stuck
Yeah, and
you're stuck with saving up to 20% down payments going forward.
yeah, and I mean, good luck with how prices are probably going to be in the future too. That's a whole other topic. But one thing I want to touch on, I know we're kind of getting close to 20 here, but for the reason why, I don't know, maybe I'm speaking just to myself here, but the reason why I'm always flip flopping between the lazy style investing versus real estate investing is because I love the fact that you can use leverage to your advantage with real estate investing. And that's huge, because what I mean by that is when you buy a rental property, you're not funding the whole thing. Let's just say you're using the 20% down. So just a straight up rental property. Where's that other 80% coming from? It's coming from the bank. Like, you're leveraging the bank's money. And that's why I love it, because the appreciation and the return you're going to get on that rental property is on the actual property value, not on the 20% that you put in. Whereas if you're buying, say, stocks or ETFs or whatever else you're doing, you're only getting the realization and the appreciation, the money you're making on that is off of the money that you're putting in. You're not leveraging. Whereas with real estate investing, you are. So that's why I love real estate investing. And I think it's the quickest way to build that wealth. It just comes with more. It's just more hands on.
Yeah, I think there's a certain element of risk to real estate investing, and a couple of those headaches, but you can mitigate a lot of that risk by, tenant selection, property selection, um, property manager, for example. A lot of these things can mitigate those risks, and you can capture the upside. It's just knowing sort of how to do it and having the team in place to help you navigate that, I think, is a big piece of the puzzle.
Yeah, exactly. Did you want to touch on anything else in terms of like buying your first rental property? Like, I know we touched on like the strategy, but anything else you want to add?
No, I think number one would be to just do the house hacking strategy. Like, that is the best. If you can find a duplex, obviously not every market has them. Or if you can't find one, come across a property where you could, let's say, convert a basement into a unit and create that kind of forced cash flow, I think those are strategies to take out the gates right away. Beyond that, it's just anytime you're getting into putting tenants in place, spend the time to vet the tenants and get the best possible one. I know, like for my rental property, I was very picky and it took about 2 months to get the right tenant in, which, yes, it kind of sucks because that property is sitting vacant. You're not earning any money on it, but you're also not stuck with the tenant who gets in there, doesn't pay the rent, and you're stuck with dealing with this government policy that benefits only tenants and doesn't protect landlords at all.
Yeah, exactly. You're gonna save more waiting a bit to find the right tenant. I would take it as if like let's just say it's a straight up rental and you're not living in it. I would screen the tenant as if you were to be living with that person to take it
100%.
that serious. And one thing before we cap this off is one other strategy that I've seen people do is if you're in a market where purchase prices are high and it's very hard to qualify and even afford the purchase prices in your market, one thing people are doing is they're buying rental properties in secondary markets in Ontario or wherever else you are in Canada. They're buying in secondary markets to at least get their foot in the door, get in the market, because then from there, you're going to have that mortgage pay down. You're going to have appreciation over the long term. Yes, right now we're not really seeing appreciation. If not, mostly house prices are flatlining or coming down. But over time, real estate is going to go up, and you're going to see that appreciation, which will help you get into the house in the future.
100%. So key takeaways are just start, get in where you can. If it needs to be a secondary market, that's totally cool. If you can build in some form of house hacking, excuse me, that's even better. And just make sure you're protecting yourself. Think about any possible risks and then figure out kind of the counter strategy to mitigate those.
Yeah, exactly. Right on.
All right.
Awesome.
Cheers, everyone. Hope you have an awesome week and we'll catch you next week.
See you guys.